People keep asking me the same question, Warren, why hasn't the market crashed yet? And I understand why they're asking. When you look at the numbers, when you study the history, when you apply the basic principles of valuation that I've been teaching for over 70 years, this market should have corrected already. It should have stumbled. It should have given us that moment where reality reasserts itself and prices come back down to earth. But here we are. The market keeps climbing, records keep breaking, and a lot of very smart people are confused. Now, I'm going to tell you something today that might surprise you, something that the big banks and financial institutions would prefer remained a bit foggy. Because once you understand what's really happening, once you see the machinery behind the curtain, you'll realize that this isn't about magic. It isn't about a new paradigm or a permanently high plateau. Those are the dangerous phrases that show up right before disasters. This is about specific forces, specific decisions, and specific consequences that are playing out in real time. And I'm going to explain it to you the way I see it. Not with fancy Wall Street jargon, not with complex formulas that require a PhD to understand, but with the simple, clear logic that Charlie Munger and I have used for decades to make sense of markets and build Berkshire Hathaway into what it is today. So let me start with something very basic, something I've been saying for years. Price is what you pay, value is what you get. And right now, there's a massive disconnect between the two. Take my favorite metric for measuring whether the stock market as a whole is overvalued or undervalued. It's very simple. You take the total market capitalization of all publicly traded companies in the United States and you divide it by the gross domestic product, the GDP. This gives you a ratio, a percentage, and that percentage tells you whether stocks in aggregate are cheap or expensive relative to the actual productive output of the economy. Now, historically, when this ratio gets above 100%, you should start getting nervous. It means the stock market is worth more than the entire annual output of the American economy. That's a warning sign. It means expectations have gotten ahead of reality. Back in 1999, right before the dot-com bubble burst, this ratio hit about 140%. I remember that time well. Everyone thought the internet had changed everything. People were saying the old rules didn't apply anymore, that we were in a new era. I gave a speech that year where I warned that stocks were overvalued and that investors were setting themselves up for disappointment. A lot of people weren't happy with me. They called me old-fashioned, out of touch, a dinosaur who didn't understand technology. But you know what happened next. The bubble popped. The market fell by over 60% from peak to trough over the next few years. Trillions of dollars in paper wealth vanished. Companies that had been worth billions went to zero. And suddenly, those old-fashioned principles of valuation, the ones I've been talking about, they didn't seem so outdated anymore. Now, here's what should shock you. Today, that same ratio, the total market cap to GDP, it isn't at 140% like it was in 1999. It's at over 215%. Let me say that again. 215%. The stock market is worth more than twice the annual economic output of the United States. If that ratio scared people at 140%, and it should have, then what should they feel at 215%? By any historical measure, by any rational standard of valuation, the market today is more overvalued than it was at the peak of the dot-com bubble. More overvalued than it was in 1929 before the Great Depression. More overvalued than almost any time in American history. And it's not just that one metric. Look at price to earnings ratios. The companies in the S&P 500, the big blue chip companies that are supposed to be the safest, most stable investments, they're trading at an average PE ratio of around 66. Now, for those of you who aren't familiar with this metric, let me explain it simply. The PE ratio tells you how much you're paying for each dollar of a company's earnings. If a stock has a PE of 15, you're paying $15 for every $1 of annual profit that company generates. Historically, a reasonable PE ratio is somewhere between 15 and 20. That's what you'd expect to pay for a good, solid company with decent growth prospects. Tech companies because they often grow faster, might trade at 25 or 30, but 66? That means investors are paying $66 for every $1 of earnings. That's not investing, that's speculation. That's hope. That's betting that somehow, some way, these companies are going to grow their earnings fast enough to justify these astronomical prices. Now, I've been in this business for over 70 years. I've seen bull markets and bear markets. I've seen booms and busts. I've seen every kind of mania and panic you can imagine. And I can tell you, when valuations get this stretched, when prices get this disconnected from underlying fundamentals, bad things eventually happen. Not might happen, not could happen, will happen. It's just a question of when. So why hasn't it happened yet? Why does the market keep going up when, by all traditional measures, it should be going down? That's the question everyone wants answered. And the answer, when you really dig into it, reveals something profound about how our economy and our financial system work today. Something that has changed in fundamental ways over the past few decades. Let me start with the most important factor, government spending. Now, I've talked about this before, but I don't think most people fully grasp how significant it is. The United States government is the single largest economic force in the world. It collects about $5 trillion a year in taxes. $5 trillion. That's an almost incomprehensible amount of money. And then it takes that $5 trillion and it spends it on Social Security checks for retirees, on Medicare payments for health care, on defense contracts for the military, on infrastructure projects, on government salaries, on interest payments on the national debt. Now, where does all that money go? It doesn't disappear into thin air. It goes into the pockets of American citizens and American companies. The retiree who gets a Social Security check, she spends it at the grocery store. The defense contractor who gets a government contract, he pays his employees and buys equipment. The doctor who receives Medicare payments, she keeps her practice running and employs staff. All of that government spending flows through the economy and eventually ends up boosting the revenues and profits of American corporations. But here's the thing that's different now. The government isn't just spending the $5 trillion it collects in taxes. It's spending closer to $7 trillion, maybe even $8 trillion, depending on the year. That means it's borrowing $2 to $3 trillion every single year to make up the difference. It's running a massive deficit. And that borrowed money, just like the tax money, flows into the economy. It becomes income for someone. It becomes revenue for some company. It becomes profit that shows up in earnings reports. And what happens when corporate earnings go up? Stock prices go up. It's that simple. The market rises not necessarily because companies are innovating or becoming more productive, but because there's this enormous fire hose of government money being sprayed into the economy, and a lot of it ends up flowing to the biggest corporations whose stocks dominate the market indices. Now, you might ask, why is the government doing this? Why is it running these massive deficits? Why doesn't it just live within its means like a responsible household or business would? And that's where we need to understand the bigger geopolitical picture. For the past 80 years, since the end of World War II in 1945, the United States has been the dominant global power. It built and controlled the international economic order. It had the strongest military, the most advanced technology, the most productive economy, the deepest capital markets, and perhaps most importantly, it had the world's reserve currency. The dollar became the money that everyone wanted to hold, that everyone needed for international trade, that everyone trusted. This dominance gave America enormous advantages. It could borrow money cheaply because everyone wanted to buy U.S. Treasury bonds. It could run trade deficits because other countries were willing to accept dollars in payment. It could impose its will on the global stage because everyone depended on access to American markets and American financial institutions. But today, that dominance is being challenged. China has risen to become the world's second largest economy. In some measures, it's actually the largest. It's building a world-class military. It's creating advanced technologies. It's establishing its own international institutions and payment systems. Other countries, India, Brazil, Russia, they're also growing and asserting themselves. They're saying they don't want to be completely dependent on the American-led system anymore. This is creating what I call a great power competition. It's not a Cold War like we had with the Soviet Union, at least not yet. But it's a competition for influence, for resources, for technological leadership, for the right to set the rules of the international system. And the United States government has decided that maintaining its position in this competition is the top priority, more important than balanced budgets, more important than fiscal responsibility, more important than almost anything else. So the government spends. It spends on the military to maintain dominance. It spends on technology and research to stay ahead. It spends on allies to keep them in the American camp. It spends on domestic programs to maintain social stability and prevent the kind of internal chaos that could weaken the country. And it does all of this, even though it means borrowing trillions from the future. Now, is this sustainable? No, obviously not. You can't borrow forever. At some point, creditors lose confidence. At some point, the debt burden becomes so large that it constrains everything else. At some point, you face a reckoning. But the government's calculation, and I think this is important to understand, is that the alternative is worse. The alternative is to cut spending, run smaller deficits, be fiscally responsible, and in doing so, risk losing the great power competition, risk allowing China or others to overtake America's position, risk ending up as a second-rate power in a world you no longer control. So they've chosen to kick the can down the road, to deal with today's challenges with borrowed money and hope that somehow, some way, the future will work itself out. Now, I'm not saying I agree with this choice. I'm just explaining what I see happening and why. And this brings us to the second major factor keeping the market up: inflation and currency devaluation. You see, when the government borrows and spends trillions of dollars that don't exist, when the Federal Reserve creates new money out of thin air to buy government bonds and keep interest rates low, you're increasing the money supply. And basic economics tells us that when you increase the supply of something, its value goes down. Think of it this way. Imagine you're on an island with 9 other people, and there are $10 in circulation. Each dollar is very valuable because there's so little money relative to the goods and services on the island. But now imagine that someone with a printing press creates $90 more overnight. Suddenly there are $100 instead of 10. What happens? Each dollar is worth less. Prices go up. The currency has been debased, devalued. That's what's happening to the US dollar right now. Not overnight, but gradually, over years and decades. The government keeps borrowing and spending. The Fed keeps printing money to finance it. And the result is that each dollar loses purchasing power. Your savings in the bank, they're worth less every year. The money you worked hard to earn and set aside, it buys less and less. Now, here's the critical insight that most people miss. The stock market isn't immune to this devaluation. In fact, stocks are a way to protect yourself from it, because stocks represent ownership in real companies that own real assets, factories, equipment, patents, brands, land. And as the currency loses value, the nominal prices of these real assets go up. Let me give you a concrete example. Suppose Coca-Cola sells a bottle of soda for $1 today and makes 10 cents in profit. That's its earnings. But now suppose inflation pushes the price of that soda to $2 over the next decade. Coca-Cola's profit per bottle might go to 20 cents. Its earnings double. And if earnings double, the stock price will probably double too, all else being equal. But here's the key. Coca-Cola hasn't necessarily become a better company. It's not producing more sodas. It's not innovating in amazing ways. It's just charging higher prices because the currency's worth less. The real value of the company, measured in terms of actual productive output, might not have changed at all. But the nominal stock price goes up because the measuring stick, the dollar, has shrunk. This is what's propping up the stock market right now. Investors aren't just betting on companies becoming more profitable in real terms. They're betting that inflation and currency devaluation will push nominal earnings higher and higher, making today's outrageous valuations look reasonable in hindsight. And you know what? They might be right. If the dollar loses half its value over the next 10 years, then a P/E ratio of 66 today becomes a P/E ratio of 33 in real terms. Still expensive, but not insane. The problem is that this game has consequences, serious consequences that don't show up in stock prices, but that matter enormously to society. The biggest consequence is wealth inequality. And this is something that bothers me deeply because I've been very fortunate in my life. I've made a lot of money. Berkshire Hathaway has been incredibly successful. But I'm keenly aware that the system that allowed me to succeed is not working for most Americans anymore. Here's the reality. About 10% of Americans own about 90% of all stocks. Let me say that differently. The bottom 90% of Americans, the vast majority of the population, own only about 10% of the stock market. Most people have very little invested in stocks. Maybe they have a small 401k at work. Maybe they have nothing at all. Their wealth is in their home if they own one, and in their savings account if they have one. So when the stock market goes up because of government spending and currency devaluation, who benefits? The top 10%. Their wealth grows, their net worth increases. They feel richer, and they are richer, at least on paper. But the bottom 90%, they don't benefit much at all. They don't own enough stocks to matter. Instead, what they experience is the other side of currency devaluation. Inflation. Their groceries cost more. Their rent goes up. Their gas prices increase. Their healthcare expenses rise. But their wages don't keep pace. Yes, wages go up a little, but not as fast as the cost of living. So in real terms, adjusted for inflation, most Americans are getting poorer while the stock market and the wealthy people who own most of it are getting richer. This is creating a dangerous divergence in our society. The gap between the haves and the have-nots is wider than it's been since the 1920s. And unlike the 1920s, when most people were farmers or factory workers who at least had jobs, today we have a significant portion of the population that feels economically hopeless. They don't see a path to prosperity. They don't believe their children will have better lives than they did. They're angry and frustrated and looking for someone to blame. Now, I'm a capitalist. I believe in free markets. I believe in the power of competition and innovation to create prosperity. But I also believe that capitalism has to work for everyone, not just the people at the top. And right now, it's not working for everyone. The system is rigged, not through some conspiracy, but through the natural operation of policies that benefit asset owners over wage earners. When the government runs massive deficits, when the Fed prints money and keeps interest rates artificially low, when currency devaluation pushes up asset prices, the rich get richer. It's automatic. It's baked into the system. And most people don't even understand it's happening because it's invisible. It's hidden behind complex economic jargon and obscure Federal Reserve policies. But the effects are real. The single mother working 2 jobs to make ends meet, she sees her expenses go up, but her paychecks barely budge. The young couple trying to buy their first home, they find that house prices have skyrocketed beyond what they can afford. The retiree living on a fixed income, he discovers that his savings don't stretch as far as they used to. These are the real human costs of the policies that are keeping the stock market elevated. Now, some people, smart investors who understand what's happening, have positioned themselves to benefit from this environment. They moved their money out of cash and into real assets, stocks, real estate, commodities, things that hold value when currency loses value, and they're making a fortune. I'm one of those people, though my strategy is a bit different than most. I'm sitting on more cash than I ever have. Berkshire Hathaway has over $350 billion in cash and short-term treasury bills right now. People ask me, Warren, why aren't you investing? Why are you holding so much cash when you just said cash loses value to inflation? And my answer is this: I'm waiting. I'm being patient because I know that this situation, this artificially elevated market being propped up by government spending and monetary policy, it's not permanent. It can't be. At some point, something breaks. At some point, the market corrects. At some point, prices come back down to earth. And when that happens, when good companies are suddenly available at reasonable prices instead of outrageous prices. I'll be ready. I'll have the cash to deploy. I'll be able to buy assets that will compound in value for decades. This is what I did after the 2008 financial crisis. While everyone was panicking, while the world felt like it was ending, I was investing. I put billions into companies like Goldman Sachs and Bank of America and General Electric. I bought when everyone else was selling, and I made a fortune because I bought at sensible prices, prices that made sense relative to the underlying value of the businesses. I'm preparing to do the same thing again because I know the cycle will turn. It always does. Markets go up and markets go down. Periods of overvaluation are followed by periods of undervaluation. It's as predictable as the tides. The only question is timing. When will the correction come? And that's the question everyone wants answered. When will the market crash? Now, I can't tell you the exact date. Nobody can. Anyone who claims they can time the market precisely is either lying or fooling themselves. But I can tell you what I'm watching for. What signs would indicate that the end is near? First, I'm watching government spending. As long as the government keeps running massive deficits, as long as it keeps pumping trillions of borrowed dollars into the economy, the market can stay elevated. But if spending gets cut, either because of a political deal to reduce the deficit or because creditors lose confidence and stop buying government bonds at low interest rates, that would remove the main prop holding the market up. Second, I'm watching inflation and interest rates. Right now, the Fed is trying to walk a tightrope. They want enough inflation to devalue the debt and keep asset prices up, but not so much inflation that it spins out of control and forces them to raise interest rates dramatically. If inflation gets too high, if it reaches 8 or 10 or 12%, the Fed will have no choice but to raise rates sharply. And high interest rates are poison for an overvalued stock market. Third, I'm watching the geopolitical situation. If the competition with China escalates into a real conflict, if there's a war over Taiwan or a major trade war or a financial decoupling, that would create enormous economic disruption. Supply chains would break. Global trade would collapse. The effects on corporate earnings and stock prices would be severe. Fourth, I'm watching social and political stability in the United States. If the wealth gap continues to widen, if more people feel left behind, if anger and frustration boil over into serious civil unrest or political extremism, that could spook investors and trigger a sell-off. Markets need stability. They need to believe that the rules won't suddenly change, that property rights will be protected, that contracts will be enforced. If those assumptions come into question, capital flees. Any one of these factors could be the catalyst that finally bursts the bubble. Or it could be something completely unexpected, something nobody is thinking about right now. That's the nature of market crashes. They often come from directions you weren't watching. But here's what I know for certain. Valuations matter. Price matters. You can't pay any price for an asset and expect to do well. At current prices, with the market valued at 215% of GDP, with PE ratios at 66, the returns for investors over the next decade are likely to be poor. Not negative, necessarily, especially if inflation continues and nominal prices keep rising, but poor in real terms, poor relative to what you could earn in a more reasonably valued market. Charlie Munger, my longtime partner who passed away last year, used to say that the big money is not made when you buy stocks or when you sell stocks. It's made in the waiting. It's made by being patient, by refusing to overpay, by sitting on your hands when prices are high and being aggressive when prices are low. Charlie understood that investing is not about being constantly active. It's about waiting for the right pitch. I think about it like baseball. Imagine you're at bat, but there's no called strikes. The pitcher can throw 100 pitches and you don't have to swing at any of them. You can wait for the perfect pitch, the one right in your sweet spot, before you swing. That's what investing should be like. You wait for the perfect opportunity, the obviously good deal, and then you swing hard. And right now, there are very few perfect pitches. Almost everything is overpriced. So I'm not swinging, I'm waiting. And I'm comfortable waiting because I know that eventually the market will give me opportunities. It always does. When everyone else is scared, when pessimism reigns, when prices have fallen dramatically, that's when the perfect pitches come. That's when you can buy wonderful businesses at wonderful prices. And that brings me to an important point about what regular investors should do. Because most people aren't in the position I'm in. They can't sit on hundreds of billions of dollars waiting for the perfect opportunity. They need to keep investing for their future. They need to save for retirement. So what should they do in this environment? First, understand what you own. If you own stocks, either directly or through mutual funds or index funds, understand that you're taking significant risk at current valuation levels. That doesn't mean you should sell everything and go to cash. Timing the market is nearly impossible. But it does mean you should be realistic about what returns you can expect. Don't assume that the market will keep going up 10 or 15% a year forever. It won't. At these valuations, future returns will likely be much lower. Second, diversify, but do it intelligently. Don't just own a bunch of different stocks. Own different types of assets. Some stocks, yes, but also some bonds, some real estate if possible, maybe some gold or other commodities. The idea is that if one asset class gets hammered, the others might hold up or even increase in value. This is basic risk management. Third, keep investing regularly regardless of market conditions. This is called dollar cost averaging. You invest the same amount of money every month or every quarter, whether the market is up or down. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this averages out your cost basis and removes emotion from the equation. You're not trying to time the market. You're systematically building wealth. Fourth, focus on quality. In a market this expensive, it's more important than ever to own good businesses. Companies with strong competitive advantages, with loyal customers, with pricing power, with manageable debt levels, with competent management. These companies will weather a downturn much better than speculative stocks or companies with shaky business models. Fifth, be patient. This is perhaps the most important lesson I can teach. The market is not a slot machine. It's not a get-rich-quick scheme. It's a mechanism for allocating capital to productive enterprises and allowing owners of those enterprises to benefit from their success. Real wealth is built over decades, not months. If you're investing for the long term, for retirement in 20 or 30 or 40 years, then short-term volatility doesn't matter much. What matters is owning good assets and giving them time to compound. Now, let me address something that the banks and financial institutions don't want you to think too hard about: fees. Most people invest through mutual funds or financial advisors who charge fees. Sometimes these fees are explicit, like an annual management fee of 1 or 2%. Sometimes they're hidden in the expense ratios of funds or in commission structures that aren't clearly disclosed. But here's the math that should shock you. If you're investing for 30 years and your investments earn an average of 8% per year, but you're paying 1% in fees, you don't end up with 7% returns. The effect is much worse than that because of compounding. That 1% fee, year after year after year, ends up costing you about 25% of your total returns over 3 decades. 1/4 of your wealth goes to fees. And what do you get for those fees? In most cases, not much. The vast majority of actively managed mutual funds don't beat their benchmark index. They underperform after fees. You'd be better off putting your money in a simple, low-cost index fund that tracks the S&P 500 and just leaving it there. This is why I've instructed the trustee of my estate to invest 90% of my wife's inheritance in a low-cost S&P 500 index fund. Not because I think the market is cheap, not because I think now is a great time to invest, but because over the very long term, owning a diversified basket of American businesses through a low-cost index fund is likely to do better than almost any other strategy, especially after you account for fees and taxes. The financial industry doesn't like it when I say these things because their profits depend on complexity. They want you to think that investing is difficult, that you need experts, that you should pay for sophisticated strategies. But the truth is simpler. Own good businesses, pay low fees, be patient. That's it. That's the whole game. Let me tell you a story that illustrates this. Back in 2008, I made a bet with a hedge fund manager. He claimed that a portfolio of hedge funds with all their sophisticated strategies and brilliant managers would outperform a simple S&P 500 index fund over 10 years. We each put $500,000 on the line, with the winnings going to charity. What happened? The index fund won easily. It returned an average of about 8.5% per year. The hedge funds returned less than 3% per year after fees. The sophisticated strategies, the brilliant managers, they added no value. In fact, they destroyed value because of the enormous fees they charged. This bet proved what I've been saying for decades. For most people, the best investment strategy is the simplest one. Buy an index fund. Keep costs low. Ignore the noise. Stay invested for the long term. You'll do better than almost everyone who tries to be clever. Now, I want to come back to the bigger question we started with. Why hasn't the market crashed yet despite extreme overvaluation? And I want to give you the complete picture, pulling together everything I've discussed. The market hasn't crashed because of a confluence of factors that are all working in the same direction, at least for now. Government spending is flooding the economy with borrowed money. That money flows to corporations and boosts their earnings. The Federal Reserve is keeping interest rates relatively low, which makes stocks more attractive compared to bonds. Inflation and currency devaluation are pushing up nominal asset prices even if real values aren't changing. And investors, knowing all this, are betting that the music will keep playing for a while longer, so they keep buying stocks even at absurd valuations. It's a self-reinforcing cycle. Higher prices justify themselves because they attract more buyers who push prices even higher. It's what Alan Greenspan, the former Fed chairman, called irrational exuberance back in 1996. Though, as it turned out, he was about 4 years too early with that warning. The market kept going up for years after he said that. But here's the thing. Every self-reinforcing cycle eventually reverses. At some point, buyers become sellers. At some point, the marginal investor decides the risk is too high and steps aside. At some point, some catalyst, maybe one of the ones I mentioned earlier, or maybe something completely unexpected, causes a shift in sentiment. And when that happens, when the cycle reverses, it can happen very quickly. Markets that seemed invincible can fall 30, 40, 50% in a matter of months. I've seen it happen. I saw it in the 1970s when the Nifty 50 stocks crashed. I saw it after the 1987 crash when the market fell over 20% in a single day. I saw it after the dot-com bubble burst from 2000 to 2002. I saw it in 2008 during the financial crisis. Every time, people were shocked. Every time, they said nobody could have seen it coming. But that wasn't true. The signs were there. The valuations were extreme. It was obvious to anyone who was paying attention and thinking rationally. The difference is that most people don't think rationally when it comes to money. They get caught up in stories. They follow the crowd. They extrapolate recent trends into the indefinite future. They convince themselves that this time is different. But it's never different. The fundamentals always matter. Value always matters. Price always matters. So what's my conclusion? What's the message I want to leave you with? It's this. The market hasn't crashed yet, but that doesn't mean it won't. The forces keeping it elevated are real, but they're not permanent. When the correction comes, and it will come, it will be painful for people who are overexposed, but it will also create opportunities for people who are prepared. My advice is to be realistic, be diversified, be patient, and be ready. Don't try to predict exactly when the crash will happen. Don't try to get too clever with market timing. But do understand the risks you're taking. Do have a plan for what you'll do if the market falls 30 or 40%. Do make sure you're not going to panic and sell at the bottom. And most importantly, keep learning. Keep educating yourself about how markets work, how the economy works, how businesses create value. The more you understand, the better equipped you'll be to navigate whatever comes next. Because here's what I know after more than 7 decades in this business. Markets go up and markets go down. Sometimes they go up for longer than seems rational. Sometimes they go down more than seems fair. But over the long term, over decades, stocks have been one of the best ways for ordinary people to build wealth. Not because of speculation or timing or cleverness, but because stocks represent ownership in businesses, and good businesses create value over time. The American economy has been the greatest wealth creation machine in human history. Despite all our problems, despite the challenges we face, despite the cycles of boom and bust, we've continued to innovate, to grow, to improve our standard of living. And I believe we'll continue to do that, not in a straight line, not without setbacks and corrections, but over time. So stay invested in America, own pieces of good businesses, be patient, be rational, ignore the noise, and you'll do fine. Not because I'm smart or because I have some secret formula, but because that's what works. It's worked for me for over 70 years. And if you have the discipline to stick with it, it will work for you too. That's the truth the banks don't always want to emphasize because it's not complicated enough to justify their fees. But it's the truth nonetheless.